Okay, hey everyone, just want to run through this quick email here. This is the follow up correspondence with the angel investor that I've been working with. Previous, to catch you guys up, previously he'd offered $100,000 for basically 15%, 50K for 10%, and then 50K later for an additional 5%. I didn't counter. I'm not like trying to bargain with the guy. I'm not trying to like squeeze out every penny from him or anything like that. I'm just trying to do what's right and what's fair. Um, but I did respond to him with actually a sort of a different proposal because I thought it made more sense. Again, I don't need $100,000 right now. And so I went back to him saying, hey, rather than try to value the company while we're pre-money and or rather pre-revenue and pre-users, we should just do something like a convertible note or a SAFE. That's capital SAFE from Y Combinator and other organizations. And so he and I had a long call when I was actually traveling to New York for the Napa conference. And we kind of got back on track. It kind of felt like it was going to fall through, but now we're back on track. And so I sent him this follow up email after that phone call, kind of just delineating everything. So just going through it really quickly. So tentative investment schedule, letting him know that this is just a hypothesis. I obviously don't want to unilaterally dictate the terms or anything like that, or make it seem like that at all. You have to walk this fine line between being confident in what you're saying and not being afraid to be assertive, while at the same time not coming across like some braggadocious asshole or something like that. Because again, they're the ones with the money. That doesn't mean that you have to go to them with your tail between your legs, because obviously you think this is a fair exchange of value. It's not like they're doing you a favor or anything like that. But still, so just a hypothesis. I originally told him 25K, but I think actually 35K would probably be actually better. So that's bad on me for not doing a more accurate estimate earlier. That obviously can lead to a lot of sort of or not overvaluation, but coming in over budget. But the main thing was that I included Android development in this as well, whereas previously I'd only included iOS. But given the nature of the startup, that it's social media, my thinking is that we would want to include it on both iOS and Android, because it would suck if you're one of the 4 in 10 people or whatever it is that are millennials that have an Android, and you want to connect and with your friends and whatever, and you just can't do it. But actually, there's a good chance that iOS would be fine. So I just sent him this basic little chart here. It's divided into sort of like the action that the startup is going to take, and then the amount of money required to get there. So the alpha stage will take about 3 months. We'll be in one city. We don't plan on having that many users. Maybe we'll actually get more than that. We should actually get more than that, really. This is probably a low projection. One thing that's working in my favor is that the angel investor honestly doesn't know that much about this type of startup. Great guy, smart guy, sold his company for tons of money, but intelligence can be siloed. It can be limited to one vertices. So in some ways, his ignorance of this type of business is actually, I imagine, working in my favor, because someone who's probably a little bit more familiar with the field might be a little bit more scrupulous and more, as a result, dubious around my projections. So what is this? This pre-seed round amount of money. This is what I'm proposing giving up. One quick point of note around not so much equity, but around ownership, was that my entire purpose in talking to him this last time was to get an understanding of why exactly he had concerns. Because again, as I mentioned, things seemed like they were going south a little bit, and really just taking the time to ask questions and really understand his perspective, which is like sales 101. It became clear that the main thing that he wanted was like ownership. And what did ownership equate to? It just really meant like basic levels of equity. It seemed like I think he might just be kind of unfamiliar with investing, because when we were talking about the convertible note, when I suggested the convertible note and the safe, he was really hesitant about that. But it wasn't hesitant when I talked about giving him 5% equity. So my thinking, and he mentioned that like saying convertible note, when I had proposed the convertible note, he mentioned something like going from 100% ownership if he started at his own thing to 0% ownership, when clearly, even when you do a convertible note, that's not like it's not 0% ownership. It's some undefined amount of ownership, but it's definitely north of zero. It's probably something like 5% or something like that. So that kind of got me thinking that he actually didn't know what convertible notes and safes were. So that's probably a good note, which is don't assume that people know something if it's any level of sophistication above universal and rudimentary. Because you would think someone who invests a lot of money would know what a convertible note is, but it seems like not. So that's an important distinction. So this is a basic post-money valuation. So for after putting in $35K, he would have 5% of the company. That equates to a $700,000 valuation. You can see the rest here, 100. This would be later. I'm proposing that he would get an additional 5% each time. Again, just a hypothesis. It's hard to say exactly what these later rounds will be worth in terms of the money to equity trade-off, since obviously we're not there. And for every unit of time you go forward in the future, your degree of certainty will decrease at least proportionally, if not inversely exponentially. So yada, 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 1.3 million, 3.23 million, whatever. So I was saying I like the simplicity of Mike. He's the investor, gets X% equity for Y% dollars, and advises a few hours per month. He proposed something like we do the convertible note, and then he advises and gets equity for that. And I think that stemmed from him not really knowing how convertible notes work, because I think he was trying to get equity, now that I'm looking back on it, when I should have just been like, hey, you get equity with a convertible note anyway, right? But anyway, the guy's really busy. And so especially when you are working with, investors, everyone talks about how like, oh, they're a strategic partner. And yeah, that's true, it seems. But honestly, I have a hard time believing that, choosing one investor over another is going to make the world of a difference. 99% of it is just going to come down to you and your team, the people who are dedicated to working on it. These people who are investors, the reason they're investors because they want to be largely hands-off on things, right? They want to invest in an asset that doesn't need them and that is going to grow on its own. It's not like they're going to come in and save your company. So I'm sure it makes a difference. I haven't really seen any data that support that. That doesn't mean that it doesn't exist. It just means I haven't really looked into it. But again, my intuition is that the effect of one specific investor over another, obviously it's going to vary depending on the type of business, but my guess is that it's honestly probably not that big of a deal. But again, that's a really uneducated opinion. Yeah, so basically I'm just saying let's address the alpha now and then the beta and then the scale later. So the goals and investments, we talked about investing more over time according to goals. There are a couple different ways you can do this. You can say you're going to get more money if you hit X, Y, and Z goals, or you can say, Mr. Investor, you're going to get X% of the company. If we don't hit any of the goals, X% minus Y%. If we hit one of the goals, X% minus Z%. If we hit two of the goals, etc. That's basically just a way of ensuring that the investor has, a certain, it mitigates the risk. Like if we get 100,000, if we don't get 100,000 users, you get 10%. If we do get 100,000 users, then you get like 5% or something, right? So yes, like his share of the pie is less, but because the pie is greater, demonstrated by the fact that we have 100,000 users, he should be happy. A sub 100,000 user pie, like 10% of 100. What am I trying to say? 10% of a smaller company is obviously going to be about generally the same as 5% of a company that's twice as big. That's the basic idea there. Sorry, that was really difficult to explain for me. One thing I am noting here is, especially given the type of business that I'm working on, which is a Catholic one, I want to keep my investors' values aligned because they're going to be easier to sell, and they're honestly going to be all probably connected in some way, which will only probably be beneficial later on. So this is only going to make fundraising easier for me later on. Like this is the first investor that I went to, and sure, I'm talking to other investors in case this one doesn't work out, but I don't want to have to go around to 1,000 different investors all the time. What I'd really like to do is to kind of scale up with this angel investor who's put in $500,000 in other companies. and keep it just between him and me so that we can scale as quickly as we need to, and I don't have to spend days or weeks trying to find other investors. Eventually, we'll have to take on other investors at some point, but for right now, I'd like to keep it between him and me. And then he asked certain questions. The biggest concern, of course, is the ARPU. That's annual revenue per user. So we wanted to know the ARPU of comps of comparable companies. And so this is a pretty old graphic I found, but it shows that even though Facebook, for instance, has increased a lot, we're realistically not going to make a ton of money from being a purely social media play, especially in our niche market. What's a successful number of people in a year? 1 million people, something like that. We can project that we're going to get maybe a buck, $2. $2 would be great. I mean, your first year, no way. So you're talking like what, $2 million? Like that's like nothing. It's almost not worth it. So the question is like, well, how else are you going to monetize? And if you notice that a lot of these are pure social media things, right? And to the extent that they start becoming non-social media, their ARPU actually increases. Most predominantly LinkedIn. And how does LinkedIn make their money? Well, primarily through recruiters and premium profiles, right? And so you look at like all these guys: Tumblr, Yelp, Twitter, Pinterest, Q, exclamation point. I don't even know what that is, honestly. So obviously I'm probably saying it wrong. Like all of them are just ads. Facebook is a ton of ads. And I honestly, I'm not exactly sure of all the other ways that they make money. Like they probably have a lot of stuff like AWS maybe that they get into, kind of more like data and whatever. Things that I'm not going to be able to replicate and get into right now. But clearly they diversify from ads. And then LinkedIn, yeah, they have a ton of ads and they probably make a shit ton on ads. But they also have their main economic driver, my thinking is, I think I've seen data on this, I'm not entirely sure, is that they make it from recruiting. And so that's a good indication that if we want to make something that's going to be worthwhile with a limited number of users, we're going to have to increase the customer lifetime value significantly. And the best way to do that is category and account expansion. So don't just have them do one thing, but have them do multiple things and spend money on multiple things. So don't just have a place for people to meet, but also get them to, use it for housing, use it for dating, use it for this, that, and the other. So expand into a lot of different things. And then especially, my guess is right now, get into jobs. Because especially coming from my other job, I know we would have paid hundreds, if not thousands of dollars a year to be able to quickly access the values aligned people that we would want. And so that alone would be a more revenue boosting avenue, I guess, whatever the hell I'm trying to say. So anyway, he texted me letting me know that he's going camping, which is why he hasn't gotten back to me. It's been 6 days. No biggie, but again, clearly I'm going to be the one driving all of this, not the investor. And you shouldn't ever wait for other people to catch up to you, or you shouldn't ever wait for people to get back to you. You should always proceed oh, it's not going to work out. Let's keep grinding. Let's keep pushing. But anyway, that's it. Went way longer than it should have.